Okay, the fight is around 11,000 on the equity screen. It's a weak start, 0.5% down on the benchmark indices. Let's move across to the commodity market and see what's happening over there. Manisha Gupta is back with us. Good morning, Manisha.
Morning, Survi, and thank you so much for that. Well, the crude oil prices to begin with has, done away with all the Feb gains that we saw in last couple of sessions. Very flat trades on the Indian markets here, and the global markets continue to see further declines. Nearly a percentage point down is how we are trading on the US crude prices right now. Remember, there have been concerns with the higher supplies in US and the production at all-time highs as well. And add to that is the slowdown in economic growth. The kind of numbers that we have seen come in from European Union, Bank of England yesterday just brings those concerns heightened, really. And we are looking at almost every country from Italy to Germany to France, all of that actually looking at lower growth in 2019. And that really has been a bit of a disappointment. What also has been weighing onto the prices is Libya, where they are looking to start their biggest oil field, Sharara, in coming few months. That would add to the global supplies. The only reason that you have $60 per barrel still holding in the global markets is the OPEC cuts and the sanctions on Venezuela. So those couple of factors continue to support, but everything else really seems to be going against increase in many of the industrial commodity prices. The gold and silver as well saw some gains yesterday in the New York session after we saw weak data from Europe. The German industrial output has declined for a fourth straight month. You also are looking at the US dollar index trading at a 2-week highs, and that continues to weigh onto those prices also. As I've been saying, we've been actually going down every single day. This is a fifth straight day of decline for the precious metal prices, but 33,000 still holding on gold, and silver now definitely below 40,000 rupees. In the global markets, we did see gold go all the way down to $1,303 per ounce, holding around 1,309 in the Asian markets right now. So some bit of a buying there. But in the Indian markets, we also are reacting to rupee in some sense. The industrial metals, the base metal prices have continued to decline yet again. We started this week with strong gains, multi-month highs for many of these commodities, a 2-month high for copper, a 7-month high for zinc, 4-month highs for nickel as well. But that has not been able to hold on. One, it is about the economic slowdown concerns which are back. And the second is the US president saying that there is no meeting on the horizon with the US president, with the Chinese president rather, before 1st of March. And 1st of March is the day if there is no resolve reached between the two countries, we will see increase in tariffs coming in between both the countries. So that is what is worrying the prices here. The strength in US dollar has been yet another thing. And the kind of gains that we saw in the recent few days, some profit taking as well has come in. So we've seen some money being taken off the table as well. Trading strategies, and we have them from Angel. They have a buy on silver, 40,400 is their target on that. But a sell continues for crude, 3640 is what they're watching out for today.
Okay. Thank you very much for that, Manisha. It might interest you to know that that has spelled some weakness for metal stocks, the globally facing stocks as well. That sort of slowdown worry is across asset classes. Let's shift back to earnings. Cummins saw a healthy growth in the third quarter, but there were no fireworks in the earnings. Domestic sales were strong. The management has also upped its guidance on domestic front. Exports are a bit choppy. I mean, actually, I'm confused about the guidance they gave. Rajiv Batra, the CFO of Cummins India, has joined us on the phone line. Good morning, Mr. Batra. You know, the 9-month export revenue growth is 12%. But you have guided for a 4 to 5% export growth, though it is still better than what you guided previously. That means in the fourth quarter, you won't do any export earnings?
No, it's not like that. We'll do less than our run rate for the previous 9 months, which will still take us to the 4 to 5% growth rate. And this is because at this moment, there are things happening in these economies where we export to. For example, the future of Brexit is unknown at this point in time. And that is impacting sales. The African economies, the exchange controls are very stiff. So we have to approach that with some degree of caution. So we are sounding a caution to say that export sales may have to slow down. And we will evaluate this as the quarter goes along. That's really what we've stated.
Let's talk about the domestic business. That's been doing really well, right? You already completed 12% in 9 months, which was your original guidance. And therefore, the guidance has been hiked now to, I think, 13 to 15%. What are the trends that you're seeing? I mean, is there a pickup? Because this is something that we always wonder, whether the cyclical part of the economy is coming back on stream or not. What is the sense as we get into the election season?
First of all, these are our highest ever domestic sales in any quarter in our 56 years of history. What is strongly coming through are the infrastructure sales, which means sales which we make to the infrastructure segment, such as the rail, such as the construction segment. And this quarter we also saw a sector which had been impacted by a downturn, which is the compressor segment, also coming back. So the initiatives around rail are known to you. Clearly there's a lot of work going on, a lot of speeding up, a lot of safety work, a lot of expansion work. All of that means good revenues as we supply some critical engines required for all of these initiatives.
Typically,
that journey is likely to continue.
Typically during elections, do they slow down? Or are these multi-year or at least say 18-month, 24-month contracts that doesn't disturb business?
Yes, exactly. These initiatives were started about, I would say, more than 24 months back. But are coming up to fruition now, as well as our own efforts to provide very appropriate products to this segment. So both things have happened. Our product offering has got way better and more aligned to the needs, as well as the fact that these initiatives will continue into the future.
Can you just give us some color on how the order scene is looking to you? How many tender or bids are out there? Are the next 6 months looking like you will? There are enough bids to be won.
The ongoing work is continuing. So, however, what we are looking at, that the number of bids now coming out as we approach a quarter with uncertainty has slowed down. So, given these continuing initiatives that are being driven, there could be 3 to 4 months of somewhat of a slowdown because of the confusion that may prevail going forward.
Okay. So then that brings us back to the first question. I mean, exports anyway, you're a little more sanguine for the fourth quarter. How does that play out once we get into FY20? Because FY20, I'm guessing first half domestic business, because of the reasons you mentioned, is going to be slightly sluggish. So overall, what should we expect at a blended level?
Domestic business, let me continue that. There is a momentum which will continue. These things can't be turned off. So all the ongoing expansions, etc., which are underway, will get completed. We will watch with interest what happens hereafter.
Fair point.
But, any government coming in, the ongoing agenda of creating employment and through development of infrastructure is more than likely to continue.
Good to hear that, sir. Thank you very much, Mr. Rajiv Batra, for joining us with those details. That's Cummins. Order flow is what he's a little worried about in terms of a slowdown in the current quarter. See, when we get the budget numbers, we dryly read CapEx has been cut because there are more subsidies. This is where it hurts.
This is where it becomes tangible, and you see companies looking at their order books, and perhaps it's a slowdown just ahead of elections. Once we have the new regime in, things should start picking up once again. That is the hope on which we survive.